currently worth what it's trading at in the open market. Likewise, option traders will vote with their wallets. Now, when it comes to things like volatility and such with an option trade, does volatility really care what direction the security moves? Not really. Granted, there might be more volatility in a downward market than an upward market, but volatility is all about magnitude of movement. Is the stock going to move up or down $5? Up or down $5? Not is it going to move down $4? It's up or down. And so as such, this can kind of walk you through the magnitude of your movement. Now, you might then have an outlook where you feel this security might, move up $2, and then so you need to compare that with, on the basics point of view, we have the perspective that there's really only 4 types of option trades you can place. You can buy a call, sell a call, buy a put, sell a put. Buying an option is bullish on volatility. Selling an option is bearish on volatility. So you can, in essence, you can be bullish on direction and bullish on volatility, bullish in direction and bearish in volatility, bearish on direction and bullish on volatility, and then bearish on direction and bearish on volatility. Those are the 4 types of simplistic single leg option trades that you can place. So that said, I'm going to shift over real quick. We'll go to option statistics. And if there's particular example securities anyone would like us to leverage, we can definitely use those. I think we're going to start off using IWM, for simplicity's sake. Though we're happy to use other symbols. Keep in mind things like SPY is extremely active, and we'll see a lot of movement with this. So I'm just going to zoom everything in real quick. Give me a moment while that kind of refreshes. I'm waiting for my screen to pop in. And there it went. A bit of a pop in there. Their AccuTrader Pro kind of reset. And I'm going to pull up, we'll do IWM first. And I'm going to zoom this back out just a tad so we can see this entire screen here. There we go. Just like that. So there's a lot of information here, a lot of interesting information. Is there trade critical information? Now, what I'd like to say, would like to, in essence, tell everyone in the audience is that the only trade critical information on this particular page is at the very top here. Volatility information. IV 30, 60, 90. Historic volatility information. We have 10, 20, 30, and 60 here. In addition to where implied volatility has been over the last 52 trading days. Now, that said, it's also important to have a very clear understanding of what implied volatility is, the difference between 30-day and 60-day volatility, the difference between the volatility implied by a particular option. That carries weight in a lot of trading decisions as well. But this can help provide an outlook on, in general, should you be a volatility buyer versus a volatility seller? From that particular perspective, a lot of traders, they'll look at volatility to be mean reverting, going back to the middle. And so when implied volatility is a little bit elevated, we see it's in the 75th percentile. They might have the expectation it's going to come back down, so they might be a seller. Likewise, when it's down at the bottom, it's at 15 to 17, which is in the bottom percentile, they might tend to be a volatility buyer. Now, that said, one of the biggest trades, like 2018 to 2020 and such, pre-COVID, was selling volatility. And you had the VIX index was breaking 10. A lot of analysts thought it is impossible for it to break 10. It was breaking 10, getting prints below 10. And traders are going, man, this is so low. This is the lowest it's ever been, the lowest it's ever will be. And so if you took that perspective, you went, well, got to buy volatility because it's low. It should be mean reverting. VIX averages, 14, 16, 18. What would your pocketbook have said? What would the reaction have been? in hindsight. Well, historic volatility was like 6. And so if you sold vol when it was at 10 and you realized 6, it would have been a profitable trade, regardless of that mean reverting nature aspect of it. Likewise, if we take something like, let me just shift over and we'll do NFLX. I'm pulling up Netflix because it's, one of those big companies everyone is familiar with. Also has an expectation to announce earnings coming up. Because of expected earnings, we can see some of this information. I have higher implied volatility, higher 30-day implied volatility, because that we see it's on the higher end of its 52-week range. Now, that said, should we be selling vol because it's at the higher end? Well, if you expect Netflix to just have a unexpected earnings announcement, either really good so it shoots up or really bad so it drops like a rock, potentially you might be expecting even more volatility than what is being priced in. So you should be a volatility buyer. So this, you still have to bring this back to what are your expectations, but this can give you a very, very clear view of the market's expectations so you know what to trade. Because you're not just having the choice of buying stock or shorting stock. You also have to take a stance in volatility, a stance in magnitude of movement. Because there's so many traders I know that have bought an option, bought a call because they thought the stock would go up. They got the exact movement they thought it was going to do, but they lost money. Why? Because of volatility. So that's, to me, what makes this an important aspect of planning a trade. Now, the rest of this information, this order flow information, is just interesting information to know. Though the useful aspect can depend. I'd like to walk everyone through a little bit of a thought example here. So I'm just going to start alphabetically. I'll start security A here. And I'm going to go A, B, C. So some of this other information can be useful, like 90-day average volume. How is it useful? Well, if you're trying to look for ideas, look for underlyings to trade on, typically traders will cross off their list any stock that has an option volume of less than 5,000. Many traders will cross off their list any stock that has an option trading volume less than 20,000. Well, why is that? We pull up a quick quote for the security A. We see 134, it's 20 cents by 25 cents. Okay, bid-ask spreads, reasonable volume. You could definitely trade this stock. Lots of volume, easy to get in and out of. But what about the options? I can tell you right off the bat that there's likely not a lot of liquidity in the options. And let's pull up an option chain real quick on security A. What is it we see right off the bat? July, August, November, January, February, January. Hey, where's the option expiring next Friday and the Friday after? There are no weekly options here. There are some elite options. We have the January and the January here, but there's no weekly options. Likewise, when we dive in, we can see 125, 130, 135 is going every $5 versus every $1. This security isn't participating in the penny pilot program, the at the money option 120 by 140. If comparison we went to Apple, the current largest security by market cap, we see this is every $2.50. 2-cent bid ask spread there. Or Microsoft on here. We're going to see fairly tight spreads. And so that's one thing we can tell based on that option volume. We go security B here. And when I first started going A, B, C, all three of these were right about like $40 a share. They're no longer right at $40 a share. Well, this one has about 14 average daily volume. Frequently when I pull this up, it's only 1 or 0. We can see it has 35 traded hands today. So it's actually starting to get more volume than it did, a year ago. But what might we expect? Even less liquidity in security A. As we then pull this up, We see it does have this month, next month, the next two, but it doesn't have leaps on here even. Not only that, but look how wide this spread is. The at the money option, 0 by $1.90. Going out to next month, $1.35 by 245. Then beyond that, look, 0 by $1.80, 0 by $3. You could drive a bus through these spreads. They're really wide spreads. So as such, could you sell cover calls on this security? Sure. You could place limit orders, and your order either fill at your limit or not at all. So you could get your price. You could try and get a midpoint. But what if it's moving against you and you have to get out? Likely you're going to struggle to close a position because then you're being forced to take whatever the market's offering versus wait and float your limit order out there. Security C, 120,000 contracts traded per day. It's going to be a lot more liquid. Shift over here, and immediately we noticed we have this Friday, next Friday, the following. We have weekly options on here. We have the at the money option, 153 by 156. 2 cents wide, 3 cents wide. It's also in penny increments versus nickel increments. So a lot tighter spreads. And so this becomes useful information as a way to weed out securities. If you're looking at something like, IVV, which also tracks the S&P 500, well, we can see this is likely not going to be as liquid as SPY on here. But a lot of that we can get by if we just go to the option chain, IVV. This is going to have reasonable bid-ask spreads on here, but sometimes it does, sometimes it doesn't, depending on the trader, because some traders, they might take positions in SPY or something like that to offset this. But we see 565, 910 by 990, 80-cent wide bid-ask spread going out 1 month. What about SPY on the same one on here? Well, the at the money, now this has dollars, $1 spread strikes versus $5 strikes. The at the money, 930 by 932. A lot tighter bid-ask spreads. And so this could be the importance with this is utilizing some of these numbers as a gauge of liquidity and going, well, if you want to trade options and you have 10 different stocks that you like, well, this could help you eliminate a couple of them because options aren't liquid. You could do the same thing though, just looking at the option chain. With that though, I know I haven't quite dug into some of these trade breakdowns so far. Is there any kind of thoughts you have, Troy, that you might want to share, or should I go ahead and kind of talk about some of these fields next?
Yeah, I would say again, you mentioned, Nick, that the top part of this tool is going to be really the trade critical type of information, the information that's going to tell us about things like implied volatility. Is there more juice? Is there more vol in some of the shorter dated options versus some of the longer dated options? We can see the 52-week range of, for example, the IV30. That can give us a good just initial pulse check of how expensive are these options given a single underlying in terms of where they've been in the last year. And, being in the midst of earnings season, and Nick, you and I just were in yesterday a session where we talked about trading options around earnings. This is very important to know. And talking about a lot of the volume dynamics, very, very important. We can look at today's volume and say, how does that compare to, for example, the 90-day average volume of options? So, knowing that, we can kind of dig a little deeper into the options that are sold on the bid, bought on the ask. That's going to give us a little bit of a deeper glimpse into some of the flows of options. It's a little bit murky, it's a little bit messy, and that's also going to lead into when we talk about things like today's biggest trades. It's meant to kind of be thought-provoking, maybe give us some ideas. But again, the big trade critical information is volume. Is there more volume than typically there is? Does it trade enough volume where it's even worth approaching this from a trading perspective? We know there's many underlyings that don't trade a lot of options. And like you mentioned and showed, the liquidity dynamics might be very unfavorable from a trading perspective. The width of the spread as a trader is our cost. You might say, well, Troy, isn't there a commission when we trade options? And correct, there is 65 cents a contract. Let me ask you this, for each contract, if there's more than a dollar, right? If there's literally a perfectly tight spread, that still is more expensive than the commission. So you care way more about the spread in terms of cost than you should about 65 cents per contract. That's a very, very small
Yeah.
commission when you think about it, relatively speaking. So, Nick, let's get into some of the, unless you want me to do it, I'm happy to do it as well in terms of the bought on the ask, sold on the bid, because those can be interesting as well.
Sure. And something I want to share with everyone is this is news and research and options on fidelity.com. I'm going to go IVV right here. Actually, we're asked if we could use Netflix, so NFLX. And we see some of these things, key statistics, IV index, and such. I'm actually going to click on key statistics. And this will pull up a lot of the same information. Total call volume, average volume, open interest, what we see with this AccuTrader Pro tool. This will also combine the today's biggest trades tool with it in one page. So for those of you that might be on a Macintosh, like was mentioned, and don't really want to use AccuTrader Pro, you can get a lot of this information on fidelity.com. So shifting back over, most of the stuff is fairly self-explanatory. On the top, total volume, 90-day average volume, open interest, average open interest over the last 90 days. Also, we have calls versus puts on this. And let me go ahead and shift this back over to Netflix as well. One thing that a lot of traders will look at as far as, is this bullish or bearish? Because this will also have on the top of an option chain, call the put ratio, bullish or bearish. Many traders will look at this as, potential contrarian type indicator. When there are a bunch of calls being traded, almost 2-to-1 calls versus puts, traders might look at that as being contrarian, a little bit similar to, historically with odd lots. When there are a lot of odd lots being traded, is seen as being the little individual investors versus the smart money institutional investors, and have seen, well, by the time that the smaller investors started getting in, well, it was already the end of the play. And so that was seen as a counter indicator. And so some traders look at this and go, well, when this gets too much calls or too much puts, that can be a counter indicator. So if you see, a 2-to-1 ratio of calls to puts, while that might show it's being bullish, that might mean bearish, that we're hitting a top or over exuberant. Likewise, when there's 2-to-1 bearish, twice as many puts being traded as calls, that could be seen as too much panicky and we're about to hit the bottom. Everybody's already selling out. Something else to think about, though, is that not every trade is bullish or bearish from this perspective. What if you're selling some puts for income? You traded a put. Is that bearish? Not necessarily. Yes, somebody bought the put and maybe they were bearish in buying the put from you, but it could also have been a market maker that immediately hedged off their risk, so to speak, and wasn't really bullish or bearish from that perspective. So that's kind of where some of this down here comes into play. Sold on bid versus bought on ask. It's a lot of traders will assume that if it trades on the bid, the initiating party, the one that was more willing to get it done, hey, let me dump it to the bid, versus the party that's having to float a limit order out there, and if it fills, it fills. The initiating party that was selling to the bid was the one that wanted to get it more done. So that's where this might then be considered to be that side of the trade. And selling calls to bid would be bearish. Selling puts to bid would be bullish because you're selling a put. Now, we also don't know whether these are opening trades or closing trades as well. And this kind of can build into, we talk about the today's biggest trades tool, but this can let us know whether an option is sold to the bid, bought from the ask, trades at the bid or the ask. Was it out with the money? So was a strike out with the money or not, etc. on this. Then some of the rest of this is, with the net delta, Long calls are positive delta, short calls are negative delta. So if a call is bought on, if it's bought, on the ask, that's going to be positive delta. If it's sold to the bid, that's negative delta. And so some of this can come into play that, like with the calls, when you see net negative delta, that can mean a couple of things. One, if they're all at the money, then net in general, there's more calls being sold than bought. But also, if you look at it and you see, well, there are more calls being bought than sold based on the bid and the ask. Well, there could be that people are buying out of the money calls with a lower delta and then selling ones that are at the money, maybe because they bought it and then it came down there, they're ringing the cash register. There could be different reasons for this. And then premiums then deal with, is a premium being paid versus a premium being received on this. Easy way to kind of check yourself if you're not ever sure is simply right click. You can come down here to help. And this will launch a new window and it will have a dedicated help field and it'll explain each of these fields, what they mean. So you can come down here to option statistics. It explains all these implied volatility fields. And we can even see, just like I was saying with the net delta, each option trade has a delta. And for calls traded on the offer and puts traded on the bid, it's positive. If you sell a put, it's positive delta. If you buy a put, it's negative delta. And it's kind of summing up all these trades that are bought and sold, positive, negative delta, to give you a net calculation. Then the same thing with the explanation of net premium. So if you ever can't remember what any of these fields are, right click help to dig into that. With that though, Troy, unless there's anything else that you might want to address in the option statistics tool or any other questions that came in, why don't we segue over to the today's biggest trades tool?
Absolutely. And another thing I would add to, Nick, is when we're looking at, again, sold on the bid, bought on the ask type of dynamics, we need to keep in mind how many or how much of the relative daily volume is bought on the ask, sold on the bid. This will be different with each underlying. For example, if we're looking at Netflix, 82,000 daily 90-day average volume, not as much as some of these other underlyings, but a decent amount. If we're looking at, again, puts that are sold on the bid, bought on the ask, it's only about 27% of total put volume. So to me, that means don't put as much weight because it's a much lower overall percent on the underlying volume. Whereas if we go to, for example, we showed IWM a moment ago. If we're looking at put volume, okay, so if we add up the sold on the bid and the bought on the ask, that's telling me about 79% of the put volume is either sold on the bid, bought on the ask. There's a lot more volume. There could be reasons for this. When there's tighter spreads, we might see a lot more of the volume sold on the bid, bought on the ask. When there's much wider spreads with lower liquidity, we're probably going to see a lot more fills in between just because the extreme difference in spreads is going to result in unfavorable pricing. So again, this is much in the new kind of in the weeds type of data. So again, a lot of the trade critical stuff up top here, but shouldn't be ignored, can be interesting, can give you a good kind of thought process. Sometimes you can get some perspectives there. So let's move over to today's biggest trades. This is kind of a short session, like you said, Nick, kind of a quick hit. We did get the symbol request of Netflix, so let's stick with that. That's reporting earnings today, or I'm sorry, not today, this week. It's going to be Thursday after the close. And with today's biggest trades, it's going to be telling us some additional information about some option trades and about the option trade flow. What we can do here is it's going to give us 20 different data points where it's going to show us the biggest trades. Now, if we look here, we can see the biggest trade here is of the day, and this refreshes. So if a bigger trade comes in, other bigger trades can be pushed down if they're smaller. So if we're just looking at what's some of the biggest trades going on, we have to first think, okay, how much premium is actually being traded? What's the notional value? Sometimes we can see, oh, wow, 1,000 contracts were traded, but maybe it's a closing trade where it's 15 cents And so could somebody have, slung an option for 20 cents and now they're going to close it for 15 cents? We might not put as much weight on that versus something like, wow, this is a very large trade. So there's a couple different things we should take a look at. I'm going to full screen this and then I'll kind of take a deep dive to see how we might interpret some of this data. So there's going to be a timestamp on each of these trades. A black trade or a trade line with black lettering says it was filled somewhere in between the bid and the ask in terms of when that trade was filled. If it's red, that means it is filled on the bid. So we are very, very confident that this is a selling transaction. Now, whether it was a sell to open or a sell to close, we really don't know that. There's an extra step that sometimes we can tell. I'll show that in a minute here. For Netflix, currently, I'm not seeing any trades of today's biggest trades that are green. But if you see green, that means it was traded at the ask. So that means we are very, very certain this is a buy side transaction. So we see a lot of black here. That means there's a lot of action filled in between the bid and the ask. When we looked at the stats, it told us that a lot of the volume is in between the bid and the ask. So that's pretty typical. So just looking at the biggest trades, again, we can sort by quantity. I think it automatically will sort by quantity. We can also do things like sort by time. So I can sort by time and say, let me look at some of the most recent big trades. And sometimes you'll see there's two trades that cross at the same time, and they're part of, for example, a multi-leg order. Again, when they're both black, it's hard to tell in terms of what's on the sell side, what's on the buy side. One thing you can do, again, we're getting a little bit murky here. We're getting a little bit in the weeds. If I look at this trade, it was the 680 call and the 682.5 call. For example, this was filled at 17.18, 17 spot 18. The bid was 17.10. The ask was 17.40. That's a 30-point spread. Midpoint would be about 15 cents. That would be pegged at about 17 spot 25. This means it was filled on the left side of the midpoint. That tells me probably a selling transaction. We don't know that for sure, but that would be my gut instinct if I had to guess, so to speak. Of course, this is why we put a big asterisk next to this data because it's not trade critical. It's just interesting to look at. If I look at this one, 682.5 call, it was filled at 16 spot 48. Well, at the time, the bid was 16 spot 25 by 16 spot 55. That's about a 30-point spread. 30-point spread would be 15 cents in the middle. That would be about 30, let's say 30, 35, 40 cents would be the midpoint. This was above the midpoint. So ideally, this was probably on the buy side. This was probably on the sell side. We're selling the 680 call and we're buying the 62.5 call. That would be my guess. I don't know that for certain. That would make sense. That would mean that's an upside call spread that's being sold. That's a bearish call spread. I'm going to just resort my data. It does refresh every about 30 seconds or so. So again, looking at this, we can say, all right, somebody is selling, or likely, we don't know for sure, selling 680, buying the 682. What's the difference in price here? They're selling, receiving maybe about 18 minus 1648. We could do the math there, look at the risk reward. We could even put this into our profit loss calculator and say, would this trade make sense? And again, this could be a market maker. This could be a floor trader. This could be somebody just managing their book. And maybe they're just, trading off and managing their delta. Who knows? Now, another thing we can do, and I know we're getting close to time. I'm going to close up pretty soon. We can look at the biggest trades. And for example, we know that Netflix is announcing earnings after the close on the 18th. So the 19th, or this Friday, is a big expiration to watch. Interesting that pulls my attention is we see 200 contracts traded by itself on the 610 strike put, and it was filled at 10.05. The spread was about 9.95 by 10.20. That's again about a 5 plus 20. That's about a 25-cent spread. This was filled about 10 cents above. So this might have been on the sell side. Again, we don't really know. Now, you might think to yourself, would I be selling the 610 put for 10 bucks? It's trading at 649 right now. And so what we could do is we could do a couple things. We could actually pull up a chain and say, okay, 200 contracts were sold or traded. We don't know necessarily they were sold, but let's look at this. I'm going to go to my option chain. I'm going to say 610, show me 610 options to 650. 650 is right about at the money. And again, if we go to the 610, we can see only 354 options were traded today. So that one trade was a big part of the 610 puts that were traded today on the July 19th. That's this Friday's expiration. There's some decent premium here.
Yeah.
610 is about 40 bucks away from where it is. That's a pretty big move. So again, might we want to say, let's go to a chart. Let's take a look at the 610 level. Would we want to be a buyer or seller of those options here? If Friday comes, I'm going to throw on the earnings flag. We can see Netflix has a huge history of big gaps around earnings.
And
So,
I believe we talked a little bit about this yesterday in our options around earnings class. The expected move for Netflix is about $55. So
oof,
right now, one standard deviation move down puts you just below $700. So if it's a within expectation, not even like a bigger than expected move, within expectation down, that could still put this option in the money by $15, which is up 50% compared to what they paid for it. If they bought it versus sold it, which we're not really sure on.
exactly. So I think, Nick, in terms of how can this tool be helpful? Well, one thing we could do is, for example, if I saw no open interest or very low open interest, and I see a big trade, that would tell us that this is an opening trade. So sometimes when you see something, an option can sometimes clearly be on the buy side, clearly on the sell side. A lot of times it's murky what side of the market. But the idea is this is the price it transacted at. How might you think about that trade? And again, I think it's a really great tool, especially if you're new to options. Play around with this tool, take a look at the chain, take a look at the volume open interest. When you look at some of these trades, think about what would the buy side look like? What would the sell side look like? And that can help the gears going in terms of understanding strength of position and kind of this asymmetric risk profile, especially going into earnings, where hey, there's a decent likelihood that maybe it stays within this range. You talked about expected move. We could, for example, just look at the straddle pricing and say, okay, instead of looking at calls puts, let's look at the straddle and if we looked at the money 650s, maybe we want to take the midpoint and say 55 bucks, like you said, Nick. If we do 55 divided by, it's trading around 650, 55 divided by 650, again, that's like an 8.5% move. So again, if that's the expected move, do you agree? Do you disagree? Do you think it's going to move outside of that range? Do you think it's going to stay inside of that range? Would you rather have a slightly bullish, type of tilt, if at all? Would you rather have a slightly bearish tilt? How might you structure that trade? Risk reward. Again, it can just be a great way to kind of think about it. You go to the profit loss tool, plot the buy side. Hey, if somebody bought and paid this price, what are they looking for? If somebody sold to open, what are they looking for? And what would be kind of the moves you'd want to see there. So I know we're at time, Nick, but that's basically kind of in a nutshell how this tool can be useful. There was a quick question. I'm just going to mention it. There was a quick question saying, hey, can we access any of this data on fidelity.com, specifically using the trading dashboard? And the answer is we could see some of this, not all of it. We talked about, the trade critical
Still building
info.
information out. Yeah.
Exactly. So some of it, the answer is some, but not all. You'll see just kind of the volume breakdowns, 52-week range of, for example, the IV30 versus the HV30. So some of the information's in there. For example, you'll see some of today's biggest trades. So again, you can see some of this in there, but again, not all of it. Some of the deeper in the weeds data is not here. So just wanted to answer that question.
One last comment I'd like to make, Troy. Can you pull back up the today's biggest trades for Netflix? A lot of people see, the biggest traders and go, man, these are the big institutions. I want to know what the big institutional player is doing on this. Well, let's look at some of these trades. One of them that jumps out to me is about 7 or 8 down. It's actually a multi-leg trade. 50 contracts, the 680 call and the 682 call. And it does say multi-leg. Now, if we assume a little bit that, maybe this is a spread, if you were to put on this trade, you're buying the 680 or 1718 and selling the 682 at 1648, that's only 70-cent difference between that. And 70 cents times 50 contracts is $3,500. So is this a $1 billion fund doing this? Probably not. And now there could have been different things on, is somebody putting on this trade or are they taking off the trade? Was this a credit spread that was sold versus a debit spread? We don't know those questions. No, we don't know the answer to some of those questions. This could have been a credit spread that was sold, in which case they would have had to put up $2.50 minus 70 cents. And so it could have been a little bit more they had to put up, but not $50,000 more. Another trade up here, 50 contracts, traded at $1.03 on this 905 strike call. Well, $1.03 times 50 contracts is just over $5,100. Again, not institutional level money. So, you too, for $5,000 at $10,000 could be one of the biggest trades that's up here. And even if you shift over to some of the really, really active names that have, 200, 300, 400 names. I remember pulling up, Apple one point in time in the second biggest trade, you could have placed for like $15,000 on here. And because it was 5,000 contracts at, 8 cents a contract or something like that. So it doesn't take a lot to hit these particular lists. And so, a lot of traders will look at this and go, this has to be a big institution, has to be a big institution. Not necessarily. These could just be, smaller investors. Especially kind of looking down, I see, the 225 put down there. It's about 1,422 contracts. Those are all kind of showing multi-leg executions, but still, even if it's a single leg, 22 cents times 1,400 contracts is only just under $31,000. So it's not, billions of dollars on this. This could be, a regular single investor, just like anyone in the audience might be. So just keep that in mind. In addition to, we don't know if somebody's buying these, if they're selling them, and we can't know for sure. You could see, that they're selling them. Well, are they selling something they had and they're now flattening their position, or are they going short that? Well, if you then go, well, they're going short that, well, and they have a short put, is that bullish or bearish? Well, what about if they're short stock and they're legging into a covered put position? Well, that's still bearish. What about if they're legging into a spread? They already had long puts. Is it legged into a debit spread or a credit spread? We don't know the whole story, which kind of brings it back to that a lot of this can be interesting information, but not trader critical. With that, though, we are 10 minutes past time. Again, I want to thank everyone for joining us, for spending 40 minutes of your morning or afternoon with us. Hopefully you found this to be a very good and valuable use of your time. With that, though, please come back, join us for some of the other sessions we have coming up on later today. We'll have our midday market brief kicking off in about 45 minutes. Robert will be back with Chase that particular session. And then I know Troy is going to be back with Andrew, right, setting stops class, and that will be at 2:30 Eastern time. Again, take care, everyone. Look forward to seeing you in the future.